So the investment that made Yale University $36 billion over time is now knocking on your door. But should you answer? Hello, I'm Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm based here in Texas. Private equity sounds so exclusive, and it used to be, but now it's everywhere, from glossy brochures to your advisor's shortlist. But is it still the high-performing secret that it once was? Let's talk about what is private equity and why it became popular. Private equity refers to investing directly in private companies, those not traded on stock exchanges, and often through buyouts, venture capital, or growth equity. It used to be a playground solely for institutional investors. Think endowments, pensions, sovereign wealth funds, big universities like Yale. Enter David Swensen. Swensen was managing Yale's endowment, famously allocated heavily to private equity, especially in the 80s and 90s. The bet paid off fabulously. His model became the gold standard for institutional portfolios. In the past, private equity really did deliver consistent outperformance, double-digit returns well above private equities. And it made sense. There are fewer investors, less capital chasing deals, and more inefficiencies to exploit. Private equity managers had access, leverage, and time on their side. Now let's fast forward to today, and private equity has become far more accessible, but that access has come at a price. We've seen the rise of what's called feeder funds, interval funds, and evergreen structures, all marketed to accredited investors. The problem is that alpha, that is the risk-adjusted returns that Swensen captured, has been bid down. More capital, more competition, fewer inefficiencies to take advantage of. Meanwhile, the fees, they haven't come down. Think 2 and 20, 2% annual and 20% of the upside, still not uncommon. And then add a layer of platform or feeder fund fees to that. So here's the real question. Is the high net worth retail investor getting paid for the risk and illiquidity that they're taking on? Recent data suggests the top quartile private equity still outperforms. But most funds don't land in that top quartile, and it's always easy with hindsight to figure out which ones do and which ones don't. If you're late to the party, you could be paying institutional pricing for something like index returns. It's just now they're locked up for 7 to 10 years. And if you can't access true top-tier managers, you're likely investing in the funds that the institutions have passed on, the leftovers. So in conclusion, does private equity still have a place in your portfolio? It probably still does, but it's not a magic bullet. For some high net worth investors, private equity can offer real diversification and exposure to assets not available in public markets. But don't fall for the marketing sizzle. Look under the hood. Understand the fee stack, the liquidity terms, and the manager quality. All things that are hard to determine on the surface. If you're considering adding private equity to your portfolio, let's talk so you can go in informed, not enchanted. We wish you the best of investing success.